Hello, everyone. I'm pleased to welcome everyone to today's webinar on opportunities on the Toronto Stock Exchange, navigating listing and regulations, which is being jointly organized by the Financial Regulatory Commission and the Embassy of Mongolia to Canada and Mongolian Association of the Securities Dealers and Capital Markets Mongolia and Toronto Stock Exchange. But before that, I would like to briefly introduce myself. I'm Timurpay Batsur, currently serving as a head of registration and licensing division of the Securities Market Department at the FRC, and I will be your moderator today. So thank you everyone for being here, for participating, and for lending your expertise on this important topic. And the objective of this webinar is to provide all market participants with thorough and comprehensive information about the Toronto Stock Exchange, TSX, and types of cross-listings available for overseas issuers, its requirements, as well as Canada's filing and reporting requirements. And therefore, we'll be hearing from the industry leaders. Today's agenda is that, first, we'll welcome opening remarks from Mr. Bayersekhan Demirtaş, Chairman of the Financial Regulatory Commission of Mongolia, and Mrs. Saruntavas Irtuntok, Ambassador of Mongolia to Canada. Then we'll hear from the two industry experts, Mr. Dudgon Batolov, Director General of the Securities Market Department at the FRC, and Mr. Graham Dallas, Head of Business Development at the Toronto Stock Exchange and Toronto Stock Exchange Venture. Just a quick note, Mr. Graham's presentation includes two topics, each followed by the Q&A session at the end. So if you have any questions, please leave it in the chat in English so we can respond accordingly. So today's webinar will be conducted in English. So please allow me to welcome Mr. Bayersekhan Demirtaş, Chairman of the FRC, to give us the opening remark.
Hello, can you hear me?
Yes, we do.
Okay. Should we start now?
Yes.
Okay. Thank you. Good afternoon, everyone.
Good afternoon.
Okay. First of all, I would like to extend my warm greetings to all esteemed market participants who have been joined us today for this webinar. I would also like to express sincere appreciation to the Embassy of Mongolia in Canada, the Toronto Stock Exchange, the Mongolian Association of Securities Dealers in Capital Market Mongolia for their support in organizing this webinar. Today's webinar, collaboration between the Financial Regulatory Commission and the Toronto Stock Exchange, aims to provide comprehensive understanding into opportunities available on the TMX. We will explore various topics such as types of cross-listings for overseas issuers, regulatory requirements, and Canada's filing and reporting standards as well. In recent years, amid global economic and geopolitical tensions, we are facing a period of uncertainty affecting trade in financial markets. However, Mongolia, with its economy primarily reliant on the mining industry, stands resilient, sustained by stable macroeconomic conditions. This improvement can be attributed to the rise in prices of its key export commodities in global market, leading to increased exports income. For instance, in the first quarter of 2024, Mongolia's GDP reached 16.5 trillion MNT, marking almost 20% increase compared to the same period last year. At the same time, the total revenue of the government budget for the same period amounted 7.7 trillion MNT, which is an increase of 2.6 trillion MNT, or in terms of percentage, 50.1% increase from the same period of the previous year. In terms of the monetary policy, as a result of implementation of strict monetary policy and the measures taken to limit the inflation growth by the central bank, inflation has decreased to 7%, and it's being kept at a relatively stable level. In Mongolia's capital market has also expanded rapidly in the recent years, marked by substantial increase in new types of financial products and the services. There has been significant growth in the securities trading activity and the number of professional investors. And I am very pleased to say that this change, accompanied by legal framework that aligns with the international standards, contribute to the emergence of favorable market environment for foreign investors. For instance, we have witnessed the introduction of the first dual currency bond, pioneering digital bonds utilizing fintech, first green bond, in the first domestically traded rating bond. Additionally, the market has seen launch of first open-end, closed-end mutual funds, as well as exchange-traded funds. Furthermore, asset-backed securities have been introduced, complemented by IPOs of systematically important banks under recent banking reform. In the regulatory landscape has also adopted to include the mining products commodity exchange in the associated brokerage regulation. The recent amendments to the loan securities market are expected to establish solid legal framework, introducing new products, services, and technologies from the capital market Mongolia. This initiative aims to simplify the process for companies to secure long-term financing through the capital market, potentially increasing investment. Moreover, these changes aim to enhance the attractiveness of Mongolia's capital market to both domestic and foreign investors, thereby stimulating cash inflows and fostering capital market growth. As a result of these measures, the capital market value peaked to 11.8 trillion MNT by the first quarter of 2024, equivalent to 17.13% of the GDP. This represents a remarkable 1.8-fold increase compared to the same period of 2023. Looking ahead, our top priorities include integrating Mongolia's capital market with the global market, providing policy support for domestic enterprise to access international financing, and improving accession regulatory frameworks to attract both domestic and foreign investors as well. Towards achieving these goals, we are actively pursuing initiatives such as supporting public companies to cross-list into issue depository receipts on both Mongolian and foreign exchanges, encouraging English disclosures for listed companies, and improving investor relations. Finance Regulatory Commission remains committed to fostering dynamic and investor-friendly environment through progressive policy measures and reforms. We are totally confident that closer collaboration between Mongolia and the international markets will yield mutual benefits and push our capital markets to new heights. Indeed, I wish you all the success in today's webinar. Thank you. Hope we will have fruitful discussions between the parties. Thank you again.
And thank you, Mr. Bayersachen, for your remarkable welcome speech. As you highlighted in your welcome remarks, I hope that today's webinar will serve as a great milestone for fostering our further collaboration between Mongolia and Canada. And now I'd like to introduce Mrs. Sarantova Sirtentsokt, Ambassador of Mongolia to Canada, to deliver the opening remarks.
Esteemed Chairman Bayersachen, esteemed Director Graham, ladies and gentlemen, I'm pleased to greet all participants joining us today for this webinar. And our embassy is truly honored to organize today's event in cooperation with the relevant stakeholders. Today, Mongolia and Canada are enjoying deeply friendly and good relations. Last year, foreign ministers of Mongolia and Canada upgraded the bilateral relationship to the comprehensive partnership and announced a joint statement recognizing the importance of diversifying the economy and expanding trade and investment relationship beyond the extractive sector into new areas such as clean energy, sustainable infrastructure, climate-smart agriculture, and education. The Government of Canada launched the Indo-Pacific Strategy in November 2022 and activating trade and economic cooperation with countries in our region. And as a part of this strategy, Canada's special envoy for the Indo-Pacific and Indo-Pacific trade representatives were appointed to the region. Moreover, new offices for government's trade and economic institutions have been opened in the region, including Agricultural Office in Manila. In overall, this is a good timing for strengthening trade, investment, and economic ties between Mongolia and Canada. Today's event is of significant importance for attracting further Canadian and international investors to Mongolia. As you all well know, Canada is one of the main investors in our country. And in addition to that, I do hope that the Canadian investment funds and pension funds could potential investors in Mongolia. So the Toronto Stock Exchange is the world's leading exchange for listing mining projects. Currently, 10 Canadian mining companies listed on the Toronto Stock Exchange are operating in Mongolia, one out of which is also listed on the Mongolian Stock Exchange. Being listed on Toronto Stock Exchange will provide companies with opportunities to raise finance from Canadian as well as international capital markets and improve their governance, transparency, and disclosure for their future prosperity. And I would like to thank again Mr. Dallas Graham for accepting our request and providing valuable information to the webinar's participants. And I believe that this event will be beneficial to all participants and will create new opportunities to you. Thank you.
On behalf of all participants here, I would like to thank you, Mrs. Sarantovas, for your opening remarks. Now we will be hearing from the two expert speakers on the subject matter. First, we'll hear from Mr. Dulgon Batulak, Director General of the Securities Market Department at the FRC, to give us a presentation on the current state and prospects of Mongolia's capital market.
Good morning and good afternoon, everyone, wherever you are. Thank you to all of you who have joined us today for this webinar. Also, a special thanks to those who helped us to organize today's webinar, especially our esteemed guest, Mr. Graham Dallas. Today in my presentation, I will be discussing various aspects of Mongolia's capital market, including its key development stages and major policy measures and its outlook. Before we begin, I'd like to mention that the FRC, as a regulator, has been actively expanding and strengthening its international partnerships with the overseas stock exchanges and regulatory authorities, such as those in Hong Kong and Australia, the US, as well as Canada, in order to integrate their best practices into Mongolia. And this webinar is the first in a series of webinars that we are starting, especially with the Toronto Stock Exchange. We hope you will find today's session informative and engaging. So I will start off with the key stages of capital market development, then move on to the current state of our capital market, including the key performance indicators. Following that, I will discuss about some of the major regulatory policy measures that we have taken in recent years and conclude with the future outlook of our capital market. So to begin, let's look at some of the key historical development of Mongolia's capital market. The market's evolution can be divided into three primary stages. The first stage began in 1990 with the introduction of private ownership, leading to the establishment of the Mongolian Stock Exchange in 1991. Another significant milestone includes the enactment of the securities market law and the establishment of the Securities Commission in 1994. Moving to the second stage, we saw the emergence of the first broker-dealer companies and the commencement of secondary market operations in 1995, as well as the trading of the first company bond on the MSC in 2001. And finally, we are currently in the third stage. Beginning in 2005, we saw the first IPO on the MSC, their introduction of government securities trading, and the revision of the securities market law in 2013. This stage also focuses on regulatory updates, including the creation of the regulatory environment of the OTC market and the mining products and commodity exchange. Our capital market comprises of various participants, such as infrastructure institutions, mutual funds, custodian banks, and service providers like audit, valuation, and the legal services, commodity exchanges, and the regulated securities firms. As of 2024, there are 615 regulated entities, showing a stable increase from previous years. And we believe this diverse participation is important for a strong capital market ecosystem. Over the recent years, we have seen significant growth in our market cap and trading volumes. For instance, our market cap, which was only $1 billion back in 2020, has now reached a record high of $3.5 billion. And this equals to 17% of our domestic GDP. The top 20 index, which tracks the performance of the top 20 companies, has grown by more than twofold compared to the 2020. In terms of the securities trading volume, it has increased by tenfold between 2020 and 2023, especially during 2021. The trading volume peaked when the policy rate was at low level of 6%. In addition, during the first quarter of 2024, corporate bonds and equity trading volumes reached significant levels, contributing to the overall market growth. And lastly, with the emergence of the OTC market back in 2021, in just 3 years, at a total of over $600 million worth of debt instruments were raised, as it is much cheaper and faster to raise capital on the OTC market. More and more companies are issuing bonds, so we expect these figures to increase further. In the past, the capital market involved in the trading of only a few types of financial instruments, but now our market offers a wide range of products, including equities and corporate bonds, asset-backed securities, and various types of mutual fund shares. By providing a broad range of financial instruments, we aim to reach different investor needs and risk appetites and making our market more attractive and dynamic. So now let me discuss some of the key regulatory policy measures that have been implemented during the past few years. Firstly, one of the major steps that we have taken was aligning our payment and settlement processes with international standards. The transition to the T+2 settlement system from the previous T+1 system back in 2020 has improved efficiency and reduced settlement risk. Another significant milestone for Mongolia was the inclusion in the developing frontier market classification by FTSE Russell of the United Kingdom. Additionally, regulations for cross-listing and depository receipts have been introduced and revised to attract foreign investments and increase capital inflows. So these measures are designed to improve market efficiency and investor confidence, positioning our market competitively on the global stage. So we have also refined our regulations on several key areas to improve market functionality and the investor protection. So these include the revision of regulations on regulated activities, securities registration, investment fund, and the asset management company, and the issuance and registration of asset-backed securities. Please, next slide. Now, another notable milestone in our market was the IPO of systemically important banks under the banking reform. According to the additional changes made to the law on banking in 2021, so systemically important banks are required to become publicly listed companies, and no single shareholder can own more than 20% of all shares. As per these changes, the five SIBs offered 5 to 10% of their shares and raised approximately 140 million USD from the public, which increased the market cap by 1.7 billion USD. With over 72,000 investors participating, this reform has shown strong market confidence and public interest in our financial sector. These successful IPOs have not only provided capital for the banks, but also expanded their investor base and deepened the market. Continuing on the market development in 2022, the government of Mongolia has approved a list of several state-owned enterprises to be privatized in order to stimulate market activity further. As per this initiative, the Mongol Post and the Mongolian Stock Exchange went public by offering 34% of its shares through the stock exchange. And these privatization moves are expected to bring more transparency, operational efficiency, and market-driven management practices to these entities, benefiting the overall economy. Now, another notable development in our market is the enactment of the law on mining products commodity exchange. Since the law's enactment in 2022, we have recorded significant trade volumes of various mining products, such as fluorite, iron, coal, copper, and molybdenum, and amounting to a combined value of almost 4 billion USD. And as per the law, the Mongolian Stock Exchange was given the permission by the FRC to act as the sole mining products commodity exchange. The establishment of this commodity exchange is expected to improve price discovery, market transparency, and provide a platform for buyers and sellers to hedge against price volatility through derivatives. Another significant policy measure that we took last year is the initiative aimed at top 100 enterprises to increase their involvement in the capital market. This initiative supports large enterprises through policy support by simplifying and easing the process of issuing the corporate bonds and conducting IPOs. For instance, top 100 companies are exempt from conducting asset valuation, are not required to provide any collateral or guarantees, are not obliged to enter into underwriting agreements, and their requests for securities registration are completed within 10 working days, etc. The law on securities market, which is the main law that governs Mongolia's capital market, has undergone several amendments since its enactment back in 1994. And a very recent amendment was approved by the Parliament just last month. The amendments to the law focus on several key areas. These include increasing the number and types of products, simplifying securities issuance process, supporting infrastructure and organizational reforms, increasing the number of professional investors, and as well as promoting market development. Overall, we are aiming to attract innovation, more participants, and increase overall market growth. As a complement to the securities market law, we have also amended the laws on taxation to create a more favorable taxation environment for securities issuers and the investors. So, for example, taxes on dividends and interest income have been reduced. Additionally, IPO-related expenses can now be deducted from taxable income. Furthermore, income generated by investment funds is now exempt from tax, and there are substantial tax reductions for income from the sale of debt instruments and shares. Moreover, the capital gains tax will be reduced 90% from 2024 to 2026, and then by the 50% from 2027 to 2029. These changes are expected to make our market more attractive to both domestic and foreign investors, encouraging greater participation and investment. Looking ahead, we expect continued growth in market driven by the banking reforms, IPOs of state-owned enterprises, securities issuance by top 100 entities, listings of strategically significant mineral deposits, and of course the cross listings of major large companies on foreign exchanges. So through these efforts, our aim is to increase the current market cap to $10 billion by 2026. With this in mind, we will remain focused on creating a strong capital market that supports economic growth and development. So that's it from my end, and I hope the presentation was both insightful and informative, and you were able to get some valuable information. Thank you all.
So thank you very much, Mr. Dudgon, for your informative presentation. So now, moving forward, I would like to invite Mr. Graham Dallas, who is currently serving as a head of business development at the Toronto Stock Exchange and TSX Venture Exchange, to briefly introduce his background. He studied at the London School of Economics. He joined the Toronto Stock Exchange in 2013 and has previously worked for both the London Stock Exchange and NASDAQ. So, Mr. Graham Dallas, you have extensive experience in the debt and equity capital markets of Asia, Europe, and North America, with a special focus on both challenges and opportunities presented by the cross-border listing. So could you please share your perspectives on our topic one, a listing on the TSX and TSXV, including both primary and secondary listing, covering the ways and requirements for listing today?
Thank you very much. First of all, I'd like to thank everybody for putting this event together. It's I'm sure it's a lot of work went into it, and I'm very honoured to have been invited to participate. So I hope that my contribution is useful, and I do encourage people who have questions to put them in the chat function on the Zoom call. I'll do my best to answer them. There may be some things that I won't be able to answer immediately, but I will undertake to, if necessary, get answers and continue the dialogue, continue the conversation outside this event. So do please ask questions. I'm going to try and share my screen. I don't know, is that visible?
Yes, it's visible. Can you move to the right below so you can maximize the screen?
There we go. Is that better?
Oh, yeah.
Yes, it is.
Okay, good. Well, thanks very much. So in this part of the talk, I'm going to talk about listing, the ways that companies can list, and a little bit about why it's a good idea. First thing I'd like just everybody to realize is that beyond the Toronto Stock Exchange, Canada itself offers a very strong environment for companies to do business, whether that's in capital markets or any other aspects of the financial markets. Canada has a very low debt to GDP ratio amongst the world's largest economies, and by lots of measures, one of the soundest banking systems in the world. That has been something of a that's, of course, in many ways, that's a great strength. It has also been in some ways something of a limit. The Canadian banks are traditionally rather cautious and conservative, which obviously has some benefits, but also some drawbacks. I think in the last year or two, I would say since the end of the COVID situation, some of the Canadian banks are now being much more outwardly looking and perhaps a bit more entrepreneurial. So I think that's a very supportive factor. I also want to point out that the Canadian capital markets are large. One of the 5 big centers around the world, and particularly in the mining industry, which I'm going to focus on here today. As was previously remarked, Canada is the most important mining market for raising money for companies from all around the world. There's one other thing I would like to point out, which is that these days, the difference between the Toronto markets and the London markets is very small. If we'd been talking 10 years ago, the London markets were significantly larger than Toronto. Again, not just in mining, but in the aggregate market cap of all the companies that were listed in London 10 years ago, that was maybe 2 or 2.5 times the size of Toronto. Now, Toronto is at least as big and possibly a little bigger than the London market. Again, that's not just because of mining. I think mining has been very helpful, but in lots of areas, the Canadian market has become very, very strong. Of course, there's no getting away from the fact that the US markets remain the biggest and deepest in the world. But particularly for mining and particularly for cross-border listing, Canada offers a very compelling base. We have nearly 250 international companies listed with us. It's a very high proportion of our listed issuers. Over half of that has come in the last 5 years, and during that last 5 years, those international issuers have raised 22 billion Canadian dollars. One of the things that I think is interesting about this is that our biggest source of international listings is the United States, which is in some ways surprising because, of course, America has NASDAQ and the New York Stock Exchange. So why do they need Toronto? Well, I think there are two things. One, they need Toronto because Toronto offers a very good platform for, let's say, small and mid-sized companies to go public at an earlier stage than they can in the United States. And two, Toronto offers an excellent mining market. And I would say, the best mining market in the world. There are, in fairness, I should say that the Australian Stock Exchange also offers a very strong platform for mining. But, I would argue that Toronto is the world's leading mining market. And we see a lot of American companies listing with us for that. But of course, we have companies from around the world, as you can see in Europe, in Asia, in Africa, and pretty much everywhere around the world. Now, in ways in which companies can list, the first thing to make clear is that companies can list with us as an exclusive listing, or they can list with us and remain listed on their domestic stock exchange. I know we have one issuer, Airdana, who's listed both in Mongolia and in Toronto. But we have lots of companies that are listed both on Toronto and London, or Toronto and Australia, or Toronto and New York Stock Exchange, or NASDAQ Stock Exchange. We are, I would say, uniquely welcoming to the idea of dual listing, of our companies being listed with us, but also being listed on another market, which may be their home market or maybe another international market. We have a very open attitude towards that. And I think when that is done and done well, everybody can benefit. The company will benefit because they have increased liquidity and increased access to a wider range of investors. And both stock exchanges benefit. You generally, if this transaction, if this strategy is well executed, and I can talk about that later, if you like, what well executed means, then both stock exchanges see an increase in liquidity. And of course, that's what any stock exchange wants to see, is activity on their markets. So we very much welcome dual listing, secondary listing, international cross-border listing. One of the things that sets the Toronto markets aside, I think, is that we have a number of different ways in which companies can list. The traditional way is the IPO, and that is used frequently. But we also have something called a capital pool program, often referred to as a CPC, which is used effectively to produce a reverse takeover. And I'm going to be talking a little bit more about that as we go through these slides. But it's important to remember that there is more than one way of getting listed on the Toronto Stock Exchange. And I'm using the words Toronto Stock Exchange generically to refer to both the Toronto Stock Exchange and the TSX Venture Exchange. The TSX Venture Exchange is our platform for smaller companies, junior companies, companies that are earlier in their life cycle, possibly pre-revenue. So when I talk about TSX, I'm really talking about both the TSX Venture and the TSX. When a company lists, particularly if it's a cross-listing, then I think it's important, if the company is to gain the most benefit from that transaction, to do something meaningful in the market. And in general, that means either to raise some new money, to sell some shares to new investors, to raise new equity capital, or to make a major investment or an acquisition of an existing listed issuer. The reason for this is that sometimes we see companies that will do a listing, but they don't raise any money at the time of the listing. Now, that is, it's technically feasible. In some ways, it's easier. There's no rule against it. It's fine, but it tends not to produce liquidity, or at least not to produce liquidity very fast. One thing that might help that is to do a listing without raising any capital, and then a subsequent date use the listing as a way of raising capital. But until and unless a company has either raised some money or made an impact in the local market in some other way, such as through an acquisition, then it's going to be difficult to get liquidity. And without liquidity, the listing is frankly less valuable, most importantly to the issuer, to the company, but also to us at the Toronto Stock Exchange. We want to see the entities that are listed trading. That's our business, so that's important to us from a business point of view, but it's also important in the sense of developing the market and increasing the market's depth and overall attractiveness. So I said there are different ways to list, and this diagram outlines some of them, or outlines the most important ones. Now, on the right-hand side of the screen, you see there's TSX and the TSX Venture Exchange. Those are the two platforms that we operate. The Venture Exchange is, I would say, the world's leading junior market. It's a market that allows companies to be listed at quite an early stage. They don't have to have revenue, for example. And it's a platform that provides a good structure for companies to grow, to gain experience of being public on a leading capital market, with a leading stock exchange, and in due course, if things go well, to graduate, as we say, onto the TSX onto the TSX. So on the TSX, there are over 700 companies that began their lives on the TSX Venture Exchange. Actually not the largest, but the second largest of our mining companies on the TSX, a company called Wheaton Precious Metals, they began as a very small issuer on the TSX Venture. About 30% of all the companies that are in our main index on the TSX began their lives on the TSX Venture Exchange. So it's a very strong, very well proven platform for young companies to make their debut on the markets, to begin their life as a public company, and it provides an environment where they can gain experience and grow. And lots of companies have done that, as I've said, well over 700. If you look in the middle of the screen, these are the different ways in which a company can list. There's the initial public offering, which I'm sure most people will be familiar with. It's a kind of a standard method that's used in I think every stock exchange around the world. Then there's at the bottom of the screen dual or interlisting. So, for example, a company that is listed on the MSE could come and list on one of our markets. And they could also do that by means of a reverse takeover or what we call a qualifying transaction. And that brings me back to the left-hand side of the screen where you see the CPC and the SPAC. Now, I'm going to focus on the CPC because that's by far the most widely used method, and SPACs are used much less in Toronto. So a CPC, a capital pool company, is essentially a clean cash shell that is listed with the one and only objective of making what's called a qualifying transaction, this thing here, the qualifying transaction. So the CPC is listed, it has a little bit of cash, it has a listing, it will have a couple of directors, 2 or maybe 3 directors, it has no other assets, it has no customers, it has no liabilities, it has no products, and it has 2 years in which it has to make a qualifying transaction. And the qualifying transaction will be an operating company that merges in a reverse takeover with the CPC to produce a listed company on the TSX Venture Exchange. It has a number of advantages. For the operating company, it's less expensive in cash, it's less time consuming, it's less risky because if, as there normally is, there will be some money raising activity associated with this, the pricing happens much earlier. In a qualifying transaction, the pricing of any new money raised is done much sooner than in an IPO. So in an IPO, a company may spend a lot of time, a lot of effort and energy and money preparing to do the IPO. And then at the point where they go out to raise money, the market may not be as receptive as they were hoping. And they may decide that they don't want to accept a lower price. If they go through the qualifying transaction route with a CPC, this thing here, then the CPC and the operating company will form an agreement in principle. And at that point, they will try to do a private placement to raise some money for the operating company. It's done very early. So any pricing concerns are addressed quite soon in the process. If the private placement goes well, then the investors commit to investing in the company, and the money is then put in escrow until the listing process is completed. But if the market is not receptive and they can't achieve the price, the valuation that they want, then the agreement can be terminated, and the costs that have been incurred up to that time are comparatively low. So it's a less risky, faster and cheaper route for companies to go public. It's used by lots of international companies, and it's used by lots of domestic Canadian companies. Over the years, thousands of CPCs have been used by companies to go public on the Toronto Stock Exchange. It's the single most popular, widely used route of going public. So that's something that's unique to Canada, and I can provide lots of information about that offline after this if people are interested. When a company goes public, whether it's through an IPO or via a CPC, it will have to meet the initial listing requirements. And these come into various different categories, some of which are mutually exclusive. So I've grouped them into a number of broad categories. The first one is, I call it assets and earnings, or call it revenue and cash flow, if you like, according to which segment of the market a company will list on. They will need to show either assets or earnings or revenue and cash flow. Probably not all of those, but some of those. Again, according to which segment of the market they're going to be listed on, and I will give a little more detail on this in a moment, they need to show appropriate financial resources. Now, that may be formally expressed as working capital, or it may be more loosely expressed. There are also requirements around the distribution of the shares. We don't have a rule that says there needs to be a certain percentage of shares in the free float, but we do have rules around market capitalization and the distribution of shares to a certain minimum number of shareholders. The idea is that this encourages or at least provides the base for reasonable liquidity after the transaction takes place. And we also have requirements about the qualification of the management and the board of directors. And I'm going to give a little more detail on that. And finally, we may require, in some circumstances, a company to have a sponsor. And a sponsor will be a Canadian financial institution. Usually, it's an investment bank. So I mentioned, for example, I'm going to go into a little detail on this. the rules have been developed over a number of, well, decades really. So there's quite a lot of complexity. I'm just going to give some examples. And if anyone has specific questions, we can try and answer those afterwards. But on the left, we've got the requirements for the venture exchange, and on the right for the Toronto Stock Exchange. And this looks at distribution and sponsorship. So sponsorship may or may not be required for either exchange. When it comes to distribution, there needs to be a certain minimum number of shares, and there needs to be a certain minimum number of shareholders. And it can be either 200, 250, or 300 shareholders, each of whom holds a public board lot, which is normally 1,000 shares. On the venture exchange, we do ask that there is a 20% free float. That doesn't apply on the TSX, but the rules about distribution do apply, and we do have on the Toronto Stock Exchange a value rather than a percentage of shares. When it comes to management, the rules say that we should have the management, including the directors, should have adequate experience and technical expertise relevant to the company's business. So if it's a technology company and all the directors have come from the mining world, that's probably not going to be acceptable. But if it's a mining company and at least some of the directors are experienced in the mining industry, then that will be acceptable. We also require that at least some of the management and some of the board have adequate public company experience. In other words, although some of the management may well be new to public companies, we encourage companies to build their board of directors, particularly, to have public markets experience. It doesn't have to be public markets in Toronto. It could be public market experience in another market. And this includes the chairman, the chief executive, the chief financial officer, and the corporate secretary. One of the things I think most stock exchanges do this, but it's very formalized in Toronto, is that the management, senior management, and members of the board of directors must complete personal information forms to assess suitability. Basically, this is we collect information about the individuals concerned to make sure that we know and the market knows who they are, what they've done in the past, and satisfy ourselves that they're the right sort of people to be running a company listed on the Toronto Stock Exchange. We also have sector-specific listing requirements. So we have requirements for companies in the oil and gas business, in the technology sector, and I thought I would focus here on mining, partly because the Toronto Stock Exchange's international business is heavily skewed to mining. Mining is very, very important for us internationally, and it's one of the areas we look to grow our business. So we have requirements covering the level of property ownership, management track record and experience. That applies across all sectors. We require, depending on which segment they'll be listed in, either there's sufficient working capital and probably a mine life. If we're talking about an operating mine, we don't want to see someone listing a business that depends on a single asset where the mine life is very short. We have specific requirements for earlier stage companies in the exploration or development phase, which are different from the requirements for mining companies that are producers. And again, we can discuss that in more detail, perhaps offline. And the specific thing that I think is most important, really, for mining companies that are planning to be listed on the Toronto Stock Exchange is that they need a geological report, a competent persons report, which complies with National Instrument 43101. I'll talk a bit about national instruments later on, but essentially NI 43101, and around the world people refer to this as a 43101, is a standard format of geological report by a competent person that has been developed over the years in response to developments in technology, but also in response to developments in the mining industry. It's a comprehensive format that includes very specific requirements, both geological, economic requirements to show what the reserve or resource is, and how it could potentially be economically viable to mine that resource. You may be familiar with, or some of the people on the call may be familiar with JORC, J-O-R-C, which is actually quite similar to 43101 in many ways, but it isn't the same. So quite often, so for example, just today we learned that an Australian uranium company is planning to be listed in Toronto. They will be converting their JORC compliant report into a 43101 compliant report. And any competent person in the industry will be familiar with both those formats. But it is, for any mining company, they need a 43101. If it's an exploration company, it may be very minimal. If it's a complex producing company, it may be a very large document. Now, I've mentioned the different requirements according to different segments. So with a little more detail here, on the TSX Venture, we have Tier 1 and Tier 2, and this page sort of outlines that. So on the TSXV, you need at least a 50% interest in a qualifying property. For Tier 2, that's one that's had $100,000 or more of expenditure in the last 3 years, and a work program outlined where you're going to invest at least $200,000. For Tier 1 on the venture exchange, again, you need a minimum 50% interest in a property that has been demonstrated to have geological merit, and you need a work program of $500,000. And that money can come from the proceeds of the listing. We also have exploration companies on the TSX. Again, they need at least a 50% interest in an advanced property with a 3-dimensional mineralization presentation with grades that are deemed to be economically interesting, coming back to the 43101. And the work program needs to be of at least $750,000. And if there's a producer, if the company's already generating revenue from the mine on the TSX, you need at least 3 years of proven and probable, and you need to be either in commercial production or have made the commercial decision to go into production. Again, there's a lot more detail below this, but this, I think, gives a flavour of how in Toronto, particularly for mining, we have a very well-developed set of rules specifically for the industry. And when it comes to financial tests for mining companies, on the TSXV, for a Tier 2 company, we need adequate working capital for a year and $100,000 that you know where you're going to spend it. If it's going to be Tier 1, the requirements are a little higher. On the TSX, where we have exploration companies, you need to have at least $2 million in working capital, $3 million in net tangible assets, and sufficient funds for at least 18 months. Again, the finance can come from the proceeds of the listing. For a producer, the things are the requirements are phrased somewhat differently. You either, depending on whether you're an exempt producer or a non-exempt producer, you need a certain level in net tangible assets and an assessment of profitability or existing profit and cash flow. It is all quite complex, and I apologize for that. What I will do at the end of this is give you a link to the documents where you can get all that detail. But I think I'm going to stop there for now. And I don't know how we are doing for time, but if we have any questions, I'll happily try to answer them now. Or if you have questions later, if I can't answer them, I will find it later. So where do I look in the Q&A? So this is about ESG. ESG is an important consideration. On the G side of it, I think that was reasonably well addressed in the presentation. We have specific requirements on corporate governance covering the board of directors, their ability, their qualification, their experience, and their suitability. And the personal information form, the PIF, does go into some detail about that. On the environmental and social questions, the short answer is yes, it's required, but we at the TSX and the TSXV do not have formal rules. What we do have is a comprehensive expectation that there will be good disclosure around the company's environmental and social impact. In most jurisdictions, I think, in fact, probably in every jurisdiction, in order for a company to have certainly a development or production license, there'll be a very comprehensive environmental impact study will be a requirement of getting the license, and the social license to operate has become in some ways almost the most important piece of work that a company has to do before beginning mining operations. I guess the easiest way to put it is to say that we have comprehensive disclosure requirements, but we don't have specific environmental or social requirements ourselves. We certainly require companies to comply with the environmental and social laws, regulations, and rules in the jurisdiction where they're operating. And actually, I'll come on to some of that in the second presentation. But we do not have specific rules around environmental and social matters. We do have specific rules around governance.
All right. Thank you for your insightful presentation, Mr. Graham. So, participants, if you have any questions regarding the topic one for Mr. Graham, please leave your questions in the QA box. Thank you.
And also, I'll send these slides, or however you want to make these slides available. We can do that. I can email them, or maybe you've managed to keep a copy. There are sources of more information at the end of the slides. Plus, do ask me. I'll be very happy if someone has a specific question and they just want to email me, then please do that, and I'll do my very best to answer it. One thing I think it's worth, maybe this is a good moment to say it, the markets in Toronto at the moment are very active in some ways. So, for example, our mining companies in the first 3 months, in the first quarter of this year, have raised 4.4 billion Canadian dollars, which is a very, it's not our best time ever, but it's one of our best times ever. So the markets are very strong in that way. Companies are raising a lot of money quite effectively, and that's continued, I think, through into the second quarter, although I don't have the specific figures yet, but it seems to be strong. However, I should say, in all honesty, that the market for new listings is currently quite quiet. I don't know why. I think probably to do with macroeconomic issues around interest rates and when the interest rate cycle turns. I think people fully expect that market to come back to life very strongly at some point, but we don't know when that will be. What I've been doing and what we've been doing at the TSX is taking advantage of this sort of slow period in new listings to look at markets that are new for us. So I've been doing quite a lot of work in, I'm going to say Central Asia. So Uzbekistan, Kazakhstan, Kyrgyzstan. And we're very keen to develop our franchise in those areas. And I maybe it's a bit of a reach to include Mongolia, but what I mean is we're very keen to build our contacts, build our market intelligence, and build our information about that. So I'm very, what that means for you is I'm very happy to answer these, to if you have questions, to stay in touch and to give as much information as I can. I'm just wondering if I can put my I'll send my email address later. I don't know how to do it here. So someone's asked, what's the difference between dual listing and cross listing? I don't know. I think both phrases are used interchangeably, honestly. I think it depends who you're talking to. But I think what they really mean in both cases is one company listed on 2 stock exchanges. I do know a few companies that are listed on 3 stock exchanges. I think that's probably too many. Being listed is a non-trivial task. It's a complex thing for any company to do on one stock exchange. I think once you've done it on one stock exchange, it becomes a bit easier to do it on a second stock exchange because you will have most of the information and most of the processes and a lot of the documentation and structures in place, but it's still extra work. So to be listed on 2 stock exchanges is more work than being listed on one. I think 2 is enough. But I don't really think, I think dual listing and cross listing, I think that's just a sort of a phrase that people use. Another one that's sometimes used, although less, is secondary listing. I think that used to be spoken of. I think less so now, and I think for a good reason. You don't really want a secondary listing. What you want is 2 good listings. Disclosure. Material and meaningful disclosure is vital to the operation of a fair and efficient capital market, but it's also important because it provides protection for investors and overall confidence in that fairness and efficiency of the market. And we have 2 types of filing and reporting requirements. One is event-driven and one is scheduled. So I'm going to talk first of all about scheduled or periodic disclosure. So these are the disclosures that listed companies have to make in the normal course of their business. These are things that companies can plan for. They can put it in their calendar months or years ahead. They know they're going to have to do this. The most important of these are the annual and quarterly financial statements. The annual statement has to be audited. The quarterly financial statements don't. And there also needs to be at the interim, at the half-year stage, a management discussion and analysis. And broadly, what that means, excuse me, is that the company's management, in some detail, discusses the situation that the company finds itself in, the condition of the company, targets that have been met, targets that maybe have not been met, and what their plans are going forward. It's more of it's not a quantitative disclosure. It's a qualitative discussion around the progress and the state of the business. A more detailed and more prescriptive version of this is the annual information form. That also has to be filed annually. Other things that companies know they have to do is send out notice of shareholder meetings, send out notice of dividends. They tell their shareholders what the record date is and when the annual general meeting will be, and the detailed stuff like the results of any votes and any corporate governance disclosures, such as changes in the constitution of the board that may have happened in the previous period. There's more. I don't really want to put everything on a slide, but there is a detailed requirement to make periodic scheduled or periodic disclosure on all listed issuers. There's also event-driven disclosure. Now, examples of this are things like material information. So material information is really defined as something that would have an impact on a shareholder or an investor making an investment decision. So it needs to be things like a company has made a significant investment, has made a significant acquisition, has made a significant disposal. It could be that they've made a significant recruitment. If they've hired somebody who's a high-profile individual in the industry, that might be considered material. It doesn't mean things like we painted the front door a different color. It's very useful for companies to make material information announcements, disclosures. It provides investors and potential investors not just with a useful bit of information about what the company is doing, but it also provides the company with a good reason to talk to the market. And companies are often encouraged by investors and the people who advise them to keep up a good news flow. Now, in the mining sector, of course, often this is going to be exploration results, drilling results, assay results, new geological information. It's very important to provide that information. The rules say immediately, and it's very important that such information doesn't leak out. So if a company has a drill program and the programs of that, the results of that drill program are known, the cores are tested and samples are assayed, as soon as those results are known, the information has to be disclosed. It is material and it has to be disclosed immediately so that all shareholders have access at the same time. Material change report is less common. That's where a company is changing a significant part of their business. So, for example, a mining company that is perhaps operating or exploring 3 different projects, if they decide that they're going to stop work on one of those projects, that would be material change. The other event-driven disclosures are things like rights offerings or stock consolidations, basically to do with changes to the share capital, issue of securities. And there are lots of the basic rule is if you're not sure if something is material, then you should probably disclose it. At the risk of boring the market, it's better to be a bit too detailed than not detailed enough. The market operates on a system of continuous fair disclosure. So, I mean, the big one obviously would be if a company is engaged in discussions that might lead to a merger or an acquisition in either direction. But those are the main categories. I talked about timing of disclosure. If something's event-driven, then it needs to be disclosed immediately. If it's material concerning its business and its affairs, as soon as the information is available to the management should disclose it to the market. Scheduled or continuous disclosure is different. Because companies have these different obligations to produce interim financial statements, annual financial statements, and so forth, there are rules about when they can be available. So for just as an example, on the TSX, the audited financial statements need to be available within 90 days of the end of the company's financial year. And there are different periods for all these various different documents. And again, I will at the end put you in a place where I'll provide links. The way this is enforced is through something called the Canadian Investment Regulatory Organisation. So this is a self-regulatory organisation. All investment dealers, mutual fund dealers, exempt dealers, all trading activity on all debt and equity marketplaces in Canada is overseen by CIRO, the Canadian Investment Regulatory Organisation. They are the ones who will monitor the timely disclosure of material information. So if, for example, there's a situation where the share price in a company moves in radically or unexpectedly before some material information is released to the market, CIRO will monitor that and potentially investigate that, because it might mean that the information was not released in a timely and fair way to the whole market. Some market participants may have had access to the information sooner than others. I'm pleased to say it doesn't happen very often, but it does happen, and CIRO is the organisation that deals with that. CIRO also reviews the content of disclosure that is scheduled. So if a company is going to put out its quarterly statement, they will pre-file it with a news organisation that manages this sort of thing, and they will get it vetted and reviewed by CIRO to make sure that it is that it covers everything that it needs to cover. It doesn't include things that shouldn't be in there, and that it is factual. You're not allowed in regulatory required disclosure to put out things that are promotional. You can only it's limited to factual information. And as I said, CIRO has the ability and the duty to monitor trading activity to see if anything untoward might have happened. And they use various technological tools to do that. So the disclosure ratio, the markets are based on disclosure, and the disclosure needs to be full and fair. Some of it is scheduled, some of it is event-driven. The scheduled information has various different timescales that tell you how quickly it has to be released, and event-driven has to be released immediately, and it must be factual. The Canadian securities regulation, I should say at this point that I am, I'm afraid, not hugely expert on this. My comfort in saying this is that it is sadly a very complex area. So the first thing to point out is that Canada does not have a single federal securities regulator. So in Mongolia, for example, there is a single securities regulator. In the United States, there's a single securities regulator. In France or in the UK, there's a single securities regulator. In Canada, every province and every territory has its own securities regulator and its own set of regulations, rules, and policies. And there are 13 provincial and territorial securities regulators. Now, I have to say that they do work together to harmonize regulation across the country. They use things known as national instruments. So we talked in the earlier about the National Instrument 43101. That's an example of a national instrument that is recognized by all the securities regulators. But there are other areas, I'm going to say they're mostly detail areas, where the securities regulators do not recognize or harmonize regulation between them. Many of them do rely on a passport system that allows a company to deal directly with only one or two regulators. However, it is a complex environment, and although there have been numerous initiatives over the years to replace these these provincial and territorial regulators with a single federal regulator, it hasn't really come to anything. So any issuer that is going to list their securities in Canada needs to be aware that there are multiple regulators out there. The good news is that in most situations where we're talking about an international issuer, so for example, a company from Mongolia, they will deal directly, almost certainly, with one or possibly two of those regulators. And it's probably going to be the Ontario Securities Commission, which is arguably the senior one, and then possibly the British Columbia or possibly the Alberta Securities Commission. That will allow securities to be sold in the most important parts of the Canadian economy. So you'll be able to offer your securities for sale in Ontario. Now, the financial services industry is very much clustered in Ontario and then in British Columbia. So if you can comply with the requirements of those two regulators, the Ontario Securities Commission and the British Columbia Securities Commission, you're probably going to be okay. The one that's more difficult is Quebec, which is a populous and important province and a major part of the Canadian economy. They actually require documentation to be prepared in French as well as in English. Lots of issuers decide not to do that. The securities laws are the laws and regulations of the Securities Commissions. They cover things like the distribution of securities, the rules around listings, the rules around IPOs, the rules around disclosure, including the content of a prospectus and other offering documents, the financial reporting requirements, and the requirements for shareholder meetings. They also have rules around the financing that companies do and how companies can place securities either with new or existing shareholders. Early warning. This again comes under the provincial regulators. This is when a company, or I should say when an investor reaches a certain threshold in the number of shares that they own. And the threshold generally is set at 10%. So if an investor acquires 10% or more of the shares in a listed issuer, they are obliged to disclose that. And subsequent to that, they have to disclose any changes in that shareholding. So if it goes up from 10% to 11%, they have to disclose that. But also if it goes down from 10% to 9%, they have to disclose that. So the Securities Commissioner's rules cover early warning matters. They also cover things like takeovers. So when a company is being acquired or potentially acquired, there are specific rules around that. They cover insider reporting. Now, this means a company needs to disclose who is potentially an insider in a company. So that would almost certainly include, well, it would include all of the board of directors and the senior management, such as the chief executive, the chief financial officer. probably the corporate secretary, but also for example, chief operating officer, or it may well be that if someone is is managing a mine site or an exploration site, that person will probably also be considered an insider, and they have to be reported as being such. And then there are rules around insider trading by those people or anyone else who may have access to privileged information. And the last major sector where the securities laws apply are around corporate governance, and this is to do with the qualification or not of board directors, the composition of the board, how many people are on the board, and to some extent, in some areas, there may be some requirement for board members for the board to demonstrate a certain commitment to diversity. For example, perhaps by having a number of women on the board, or in some cases where, particularly where companies are operating in parts of Canada where First Nations, Aboriginal people are resident, there may be some requirement to have representation from there. I can't go into the details because there are literally hundreds of rules that cover these areas that we've talked about: the listings, distribution, IPOs, financial reporting, and so forth. There is a link at the end of this. Here we are, where you can get more information about these. So I've put all of the provincial and territorial regulators have their own websites where their rules and regulations are available. I've just put these two, the Ontario Securities Commission and the British Columbia Securities Commission, because frankly, they are the most widely used. They're probably the ones that are most relevant to international issuers. Other provincial securities regulators, you could look at them, but it's a highly specialized line of interest. And I've also recommend two documents that we produce. The first is our guide to listing. So there's a link there. And also, if anyone just wants to get in touch with me, I can provide that. It's published and updated every year. It has all of the specific requirements for mining companies, all of the specific requirements for TSX and TSXV companies in Tier 1, in Tier 2, in exempt and non-exempt categories. So far better than me trying to put all that on lots and lots of slides. I strongly recommend you look at that. It also talks quite a lot about why listing in Toronto can be useful for companies, and something about the actual process, who you talk to, law firms, banks, accounting firms, competent persons, and so forth. And then if you're really interested, there's the technical guide to listing, which is a much more detailed version of the same thing. The guide to listing, which is something of a, not exactly promotional, but it's a sales document. We use it to encourage people to think about being listed in Toronto. The technical guide is much more rules focused and has a lot more detail on all of the areas that we've discussed so far. And if you need specific answers, then that's probably a good place to start looking. But again, I would stress, please do contact me directly, and I will try my very best to get an answer for you. And I think we're going to leave it there.
Thank you again, Mr. Graham, for your fruitful and informative presentation. So since we don't have any question on topic 2, so our webinar has come to an end at this point. So in closing, I want to thank everyone for taking the time to join this webinar. And I have no doubt that everyone has gained the valuable information from the discussions that we had today, and that our cooperation and partnership will grow even more. So before we end, now we have an announcement from the Capital Markets Mongolia CMM team. Mic is yours now, Mr. Napadorj.
Thank you. First of all, it's best to reach and everyone participating for this today's webinar. and as well as for partnering organization for the support and collaboration to making this event possible. We hope that today's discussion have offered you valuable information and practical guidance that will help you navigate complexities of TSX. Lastly, I want to thank our esteemed guest, Mr. Graham Dallas. Your insight and comprehensive overview of Toronto Stock Exchange has been incredibly valuable. And I want to officially invite you to Mr. Graham to participate in MinePro 2024 International Quarrying and Mining Exhibition Convention, which take place in October 10 to 12. It's an in-depth discussion on various topics as global trends in mining finance, international regional financing opportunities, challenges, and growth prospects. So it's an initiative aimed at enhancing mining sector impact on the economy, providing support to international, national, and regional companies. And to all participants, if you have any further question or needing additional information, don't hesitate to reach out to us. The recording of today's webinar will be shared with you, as well as the presentation that was presented here. And thanks once again for joining us today. We were looking forward to see you at our next webinar, jointly organized with FRC on unlocking capital opportunity at London Stock Exchange, which will be held July 22nd. Thank you.
Thank you again, and see you next time.
Thank you, Mr. Dallas. And thank you for your time, and your speech presentation was very useful and informative. And I do hope that our attendees also were able to get some valuable information. And thank you again, Mr. Dallas. And it was very nice to meet you. And I hope sometime in the future and to meet in person.
That would be great. It would be very nice indeed. I'd like to say thanks very much for the opportunity. Very good to meet some new people and some old friends. And I look forward to continuing the discussion. Thank you.
Thank you. Thank you.
Is $2 million to show sufficient working capital. They don't have it at the moment. We will then say that they are conditionally approved, and the condition they raise that money. To raise that money for investors, then if they don't,